Hey Andrew, how's it going?
Excellent, Keaton. And yourself?
Not too bad. I can't complain.
Not
It's
too much
another
snow up there
wonderful
yet?
day.
Not too much snow up there?
Not yet, but it'll come, I'm sure. Carolyn is already starting to experience the colder nights. So,
Yeah.
but
Yeah, I know we're down to 10 degrees.
oh
Kidding.
no, I think we hit 6 last night. I think
Woo-hoo.
somewhere in that range. It's getting chillier,
Yep.
but
Cool.
so I wanted to connect. I know that you've been doing a lot of, well, let me take one step back. I've seen a lot of projects and opportunities, and just there's a lot floating around right now. I can tell the market slowed down because everybody's trying to sell something right now.
Yeah.
And for anyone who doesn't know this, Andrew's an author, and he wrote probably one of the most important books, for me at least, in the due diligence I do. Now, Andrew's a realtor as well, but I would say primarily he's an author because it's a pretty good book, and I use it to create presentations, write content, and I also use it as a guideline for the investing that I do. Um, so, Andrew, I wanted to ask you if you could expand a little about the due diligence you do when you look for a project, and is that influenced by the book or?
Well, okay. So I'm an investor first, then I became a realtor, an investment realtor, um, and I'm analytic by nature. So with that involved, the book actually came as a result of just my experience over the years of learning about investment real estate, seeing mistakes, seeing wins, and finding ways that actually would help people without this whole get rich quick thing. It's not, real estate isn't a get rich quick. I don't like betting on red or black. I like looking at that dividend type blue chip stock, which I call good real estate.
There's very few people as crotchety and paranoid as I am when I look at a deal, and I think you're one of them. So, and I say that as a term of endearment.
Well, I'm
So,
a big believer in take care, look at the downside, make sure it's taken care of, and the upside will take care of itself.
yeah,
So,
I think real estate investing is managing risk. So,
yeah, it's always about managing risk. I don't think there's too many people out there that want to do it all over again, but there are those young high flyers. I'm not one of them. Um, so when it comes to real estate, I look at every project as if I'm going to, our investment, I'm going to look at every property as if I'm going to put my mom in. So there's a level of care, and I know that sounds corny, but um, first of all, I have a very unique name, so I like to have a good reputation. I like to operate from integrity, both from an internal perspective and how other people see me as well. Um, so that's kind of the why behind a lot of the due diligence, and to reduce my risk. I'm to a degree risk adverse. And so that's why this whole idea of due diligence came about, because I've been involved in a lot of
wait, do
real
you
estate.
mean you've invested in real estate long enough to know it's not all sunshine and rainbows?
Hey, no, I definitely, and I can have personal experiences of those stormy clouds. Um,
So,
you
I
know,
wanted
I,
to ask you. I know you have a little bit of a system, and you talk about it in your book.
yep,
Uh, do you want to go through how you kind of start from the very large and work your way in when you look at a project?
yep, sure. I go from macro to micro. And the reason being, um,
So
two
macro
things.
means large for anyone wondering,
Yeah,
micro is small.
two things. Uh, the success of a real estate investment has more to do with the investor than the investment. And having said that, real estate is a function of the economy. The economy is growing, you have growth. If the economy is shrinking, you have regression. Um, and real estate is a lagging indicator. So when I start talking about macro to micro, I look at the region, the province, what is going on in that province or that state, if you're in the US. And then I'll go into the city, and then down to the neighborhood or the area in the city, and then into a property, because the property is ultimately going to be local, but it is going to be dependent on other things.
So
So,
let's say you're considering either, let's start with provinces. What do you look for in a province? Like what makes a good province versus a bad province?
well, that depends. I mean, I look for a province that is, because I do a lot of buy and holds, I look for a province that is pro business, not pro landlord, not pro tenant, um, but pro business, so that you have a market condition that can actually operate without interference um, unnecessarily. So I looked at, I've done projects and investment projects, and I've invested from BC all the way to PEI. Um, and some provinces actually do better than others in my books and in my terms. And I'm a firm believer in, just because it's cheap, don't buy there. It comes back to the fundamentals. How strong is that province economically, population wise? Where is it going? Where is it has been? How affordable is it? What rent controls are in it? All of those type of things can play a massive role on whether you're successful or not, depending on your investment strategy.
I
I.e., is it a buy and
definitely
hold? Is it a burr? Is it, fix and flip? Whatever it is you're trying to do. So it's important to understand those fundamentals behind it when you're trying to marry up your investment strategies.
No, it makes total sense. I definitely think the size of a market or a province is important too. We're seeing in New Brunswick where investors have flocked, and now we're seeing retroactive rent freezes and all sorts of changes because it's gone too far, and the province is starting to shift things to protect tenants, which means as an investor, the deal you thought you had might not be. And I've heard stories of like rent eviction models, which I'm not a huge fan of, but people come in, rent apartment buildings, and they're actually having the rent increases clawed back. So, so that's the province level. How do you then decide on one city over another or one region over another?
Um, it's funny. It's I look at the economic strengths and the diversification of those cities, the size of that city. I'm a firm believer in investing in larger cities.
I agree with you
You
there.
will typically have a lower cap rate than small towns. And that means the risk factors are somewhat less, and higher level of potential stability when you have a lower cap rate. Um, I believe in having, you know, um, rush hours. So I look for anything like 50,000 and above, where you have self-sustaining economies, as opposed to bedroom communities relying on something, 2 or 3 hours
Yeah,
away.
relying on a mill or
Yeah,
steel plant or whatever it may be.
yeah. And there's an old saying: when big cities get a cold, small towns get pneumonia. And so I tend to focus on the bigger cities because they typically have better opportunities. But what I do look for, I mean, I love capital cities of any province, and even, the capital of the country. Why? Because it's government. Government collects taxes. And what do? They spend your money on infrastructure and things like that. Um, and it doesn't mean that one city is better than the other. It's just what is my flavor. I tend to go for those more boring cities rather than the highly volatile cities. Um,
I get you. I'm always a believer of real estate investing is a little bit like horse racing. At the end of the day, we know the past performance, we know the characteristics. We get to make educated bets on something based on what we see. And we know there's competitors. And at the
yeah,
end of the day, our goal as an investor is it might not always be shooting for first place. It might be shooting for third place, but
mhm.
it's about the balance of what are your odds? What's the cost? And I definitely agree with you there, though, that it's an interesting one to compare the markets. It doesn't mean one's better than the other, but it's I like to invest in tractors when it comes to real estate personally, like slow and steady. I want
Yeah.
a 40-year timeline.
Well, exactly. And um, it really depends on what it is you're trying to accomplish. And where is that market in its real estate cycle? To me, and I'm going to quote another author, Ozzy Jurek wrote a book called Forget About Location, Location, Location. It's timing, timing, timing. And I absolutely believe that timing is primary to location, because my parents bought in a great location at the wrong time and lost money. They didn't understand where they were in the real estate cycle of that community. And had they been able to build in their system to hold on to that property, they would have been multi millionaires. But instead, they had to cut the line and move on because they were losing money. So real estate cycles are really incredibly important. And to understand the real estate cycles, it comes back down to one of the key things, which I said at the beginning, is follow the money. Where is the money coming from? So GDP is incredibly important. It's the life cycle of real estate. With influx of large capital, whether it's public or private or a combination of both, will create jobs. When you get jobs, you get people moving in. They're going to rent because they don't have the stability of a job yet to be able to get a mortgage. So they're going to rent. So then you see population growing. As a result of the jobs growing, you see the rent increases, vacancy rates drop. And then you start to see, as they stabilize, prices increase because they start to buy. They bring in their families, so on and so forth. And then, you'll see that continue up until the market starts to drop. When the GDP starts to drop, job loss, so on and so forth. So the cycle is kind of up and down. And it's understanding where you are in that cycle, not to try and pinpoint it, but to at least understand, are you buying on an upward trend or a downward trend? I've always found that it's advantageous to buy on the upward trend. And if you really don't know what you're doing, wait until there's some really good signs. And typically you'll see rents increasing. You'll see population increasing. You'll see more and more cranes and construction, but your prices will still be lower than what it would cost to build new, typically for existing product. And that's a really good time to buy.
So let's say that you've evaluated multiple markets, you found the right combination of tenancy rules and economic drivers. So you found your province you want to invest in. You've considered two regions. You've kind of looked at the breakdown of infrastructure and growth for the population, the breakdown of the economy job-wise. So now you've narrowed it down to a specific city. What do you then look in that city? How do you tell a good project from a bad one? Because the marketing is great with all of them. Every realtor is telling me it's a phenomenal deal, and not everybody's right. So how do you sort that out?
Well, okay. So it's really interesting because I'm doing a project right now called The Key in Edmonton. And I'll give you kind of an example of what I look for in that situation. So first of all, I look at the city itself. How has it been functioning? Is it showing the signs that it's going to be positive in the near future? Or is it going to be negative? Or is there, you just don't know. And so when I looked at what was going on, I had this project offered to me, these 20 units of this owner-occupier style built building. And when I looked at it, I went, okay, it's in a great location. It's in Southwest Edmonton, inside the ring road. Excellent. I did my visual search, did Google Earth. And before I even spend any money, spend any time going out there and whatnot, I want to kind of get a feel for what is that market. And what I did notice immediately is everything is built up around it. It's relationship to other key neighborhoods in that area was super strong. Its accessibility was super strong. So, okay, that's kind of cool. It was a newer neighborhood, so younger neighborhood. So that also brings in the type of people that are actually buying, living, and renting there. So that was good. Then I look at things like crime. What's the crime like in that area? Because that's really, really important for values to increase and rentability and things like that, and level of rent that you can charge.
I've found that the crime trending up or trending down relative to the whole city can be a really powerful way to see if money's flowing in or money's flowing out.
Absolutely. And you look at, what is the income area? What's the education? What is the demographic makeup of that area? Who would be a tenant if you're doing a buy and hold? Is it,
As
two
someone
guys?
who owns a couple properties in rougher parts of Edmonton is now on the brink of another eviction, I wish I would have spent more time on this due diligence when I bought my investment properties. So here's a question for you.
Yeah.
Because I spent 5 weeks as an electrician fresh out of high school, and beyond that, I'm probably more of a liability to myself with tools. How do you tell good construction specs from bad construction specs?
Oh, that's an interesting one.
Like, do you do it yourself? Do you lean on other professionals? Like,
Well, I first of all, I look at who built it. What is their reputation? What's their track record? What are the reviews of the properties by purchasers of the developer? Because we can all get testimonials, but the internet is a very powerful thing now. You can find almost anything if you search the right way, using the right key search words. I look at Better Business Bureau, I look at Yelp, I look at Google rating, I look at everything around that individual or that company. And if I have people in that market, I'm going to ask them, what do they know of this builder, developer, seller, whatever, right? Because there is lots of entry level, or what I call rental stock buildings, that are being sold as condominiums. And that means they're probably, yes. Well, they're going to use lower grade materials, lower level finishes, lower quality appliances.
I find soundproofing is a big one that we notice.
Yeah, and they will do the minimum to pass code. Doesn't mean that they're shirking their responsibility, but they're doing what they need to do to pass code. Whereas typical higher quality buildings or properties are built for owner occupiers, with soundproofing, with insulation, with quality materials in mind, so that, because they typically are going to charge a higher dollar value when they're selling the properties. So you're going to get more owner occupiers. If I'm looking at a property where it's 100% investor, not touching it. I'm not touching it, because what is my exit strategy? Another investor. Well, that's a small part of the market.
Yeah, but isn't heaven a strata run by investors that make, one would hope, rational financial decisions when they manage a building?
Yeah, and I'd like a unicorn too.
So let me ask you, on the topic of stratas, how do you do due diligence on the strata, the depreciation reports, the estoppel certificates? Like, what do you dig into there?
Oh, I dig into, I want all the minutes of the stratas. I want to see their financials minimum for the last 2 years, whatever I can get a hold of. Condo reserve fund studies are also known as depreciation reports in BC. But I like the fact some of the outside of BC, or I should say in Alberta, they have to use an engineer, not some guy that's passed a test. So there's a little more validity in their reports. I look at engineering studies, anything that I can get my hands on around the property to have a look at it. I have a little bit of a background in building. I ran a lumberyard for some years and had to learn certain code things, which are probably out of date. But you know, when was it built? So what products were used? I.e., if it was built in the 1990s, my first question is there polybute piping in there? Because that is a big problem when it does go. It means replumbing the whole house or building or whatever. So I look for those things to see where the problems are, because it's fine. Nothing's ever perfect. You're always going to find something that needs repair and things like that. But it's to what level and
Now, is
how
there a
well you
reason
prepare.
you target these bigger projects with multiple units?
Yeah. Well, yeah, for my clients, want to find turnkey properties that they can actually own. Um, they've come to the conclusion that they don't have to live in the community in which they invest. So a lot of my clients are in BC, Alberta, Ontario, some in the US, and they want to own good cash flowing properties that have a potential for appreciation. And that's why I've looked to Edmonton for the last few years, because to me, Edmonton has been in a doldrums, or for lack of a better way of putting it, the tide's been out for the last 5 years because of oil, and
I think
Alberta's
you could
kind of
argue
been
the
down.
last 15 years, but I love it.
Well, I was going to say since about 2015. So we were able to find motivated developers that are actually built properties but have stalled in retail sales. So they've had a lot of retail sales, but now they have 19, 20 units left in the project.
So
Um,
is there, when you do units in batches, does it like, can you negotiate with property managers or with the sellers? Like, does it work that way?
yes, yes, you can. How
I hear
successful
a
you
but.
are, depending on how successful you are and how motivated they are, and how well you can deliver to their expectations. It's a fine line, and it takes a lot of work, and a lot of negotiations. So I always represent the buyer side. So I'm always in contact with that listing agent or the agent that's representing the seller. So it's a dance. But again, time is money, and if their profits are in those last few units, they're motivated to get them sold, and so but they want to get them sold quickly, but they also want to get them sold at the highest potential value they can. That makes sense, so they're not losing money. Developers don't build properties to lose money, so it's finding the win-win-win. Um, And so when I'm looking at these projects, it's really important to understand I'm not there to pillage the developer, but I'm not there to let my clients get a bad deal. I look at
So
a
I could
lot of
see how if
deals.
you go to a developer who's stuck with some units that they can't move, particularly to a specific market, say the owner occupied crowd, which would generally be local buyers, you're able to position it that I'll solve your problem of your last 20 units, but I will solve it in bulk. You're going to make 30% of what you expected to make, but it's going to be solved in the next 3 months.
Yeah. Uh, if I would never get a deal where he's making 30%, he would want, if I can get, 25% discount or something like that, then that's amazing. That's amazing. Again, it all depends on the market conditions. Um,
So let
you
me
know,
ask you this on a somewhat unrelated topic. You mentioned buying or investing out of province. Um, you've got an investment property in Hawaii, right? So I have to imagine that that's a lot harder to manage than a property that's in the same country that's a $70 flight away. Are there any tricks that you've learned that you'd suggest for managing a property that's out of town?
good management. It always comes down to a good team, full stop. For my property in Hawaii, I have a repair person that I have fostered a massive, wonderful relationship. Um, I don't try and cut corners and grind him for every deal because it's just too important. I don't have the ability to just drive there and fix the problem. So again, it's creating my philosophy always is to create a win-win-win. Um,
I
and
hear
it
you
may
there.
not may not always be the most lucrative, but there's only one
I,
of me.
I get you though. Like as a professional that works for real estate investors, the longevity of a relationship I have, the go above and beyond I have for a client that has to win every single thing. And I can tell that their number one perspective is just getting the best for them. And there's no regard for those that work with them, those involved with them, or those around them. I have to be honest, the relationship doesn't last long by choice on my end. And I think it's really important whether you're working with service providers, contractors, property managers. Sometimes you got to give them a break. Sometimes you got to let them have a win. Make sure
Yeah,
you win on the really important stuff for you, but you don't have to win on everything.
yeah. Well, I agree with you. I'm still working with people from the early '90s. Sorry, mid '90s. Um, I can't help people create wealth through real estate by putting my commissions and my wins in front of my clients. And I know that may sound a little corny and, whatever, but I build wealth because I build the relationship first. Uh, if the moment I get into a transactional mentality, I'm hanging up my license.
Well,
I'm just,
let me ask you.
yeah.
I know that I've worked with you for years and I've seen this trend. So writing a book is not easy and it's not quick. And I've met far more people that are going to write a book and 3 years later, they've, not even halfway through. So I know how much time it takes.
Yeah.
What inspired you to write your book and why did you? So I'll let you share it, but I know you did something with what happens with the net proceeds. Why'd you do
Yeah.
that? And maybe explain why and where.
Okay. So I have a bookshelf. Thank you. Full. I'll talk about that in a second. I have a bookshelf full of real estate books. Some of them are all, the get rich quick and, do this and blah, 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 blah. But there are certain books that really inspired me um, around the work behind the work. And this book, Look Before You Leap, but Leap, is exactly about that. It's about doing my due diligence. So over the years, I've come across great stuff, crappy stuff, interesting stuff about real estate investing. And COVID hit, and I went, okay, that was a perfect time because I'm sort of hunkered down at home. And I figured this is the time to put all of this stuff that's in my brain down into paper and get it focused in some sort of logical sequence. But so it has very little to do with how to make money on this type of strategy or this type of strategy, but it's more the stuff behind the stuff. So building that platform. In other words, making sure the pool is full of water before you jump in. Understand your environment. So it's looking around, doing your due diligence before you start spending money and finding out that was the wrong strategy, the wrong city, the wrong, type of real estate, whatever, right? Because there's so many different ways to invest in real estate. And my whole goal was to help people look at these things and hopefully help them make more informed decisions. But at some point in time, they have to take action. So that was the whole impetus.
Definitely a more defensively minded book, I find. That's why I actually started rereading it again, just because as the market shifts, I want to be very focused on what steps can I take to protect myself and my clients. And I really, really value it for that.
Yeah. And then well, this is the way I looked at it. It was all about doing your due diligence so that you have the best chance of being profitable in what you're doing. Um, so it's more on systems and your whys and things like that. I'm proud of the book. It's got a lot of content in there. It's kind of a little go-to manual, so to speak. Oh, all about property management. Well, let's look at that. How do I understand a real estate cycle? How does that look? And what to look for in terms of economics and things like that. So then I looked at it and I wanted to find a way to marry real estate with my passions, which was music and causes that have changed my life. So I wanted to do, and I got this from actually Don Campbell of Rain, or used to own Rain, where he had the net proceeds of his book going towards charities. So he does it for Habitat for Humanity. Well, I have it for World Vision. I have it for Kiva, and I have it for Sarah McLaughlin School of Music, because I want kids to pick up musical instruments rather than things that are less supportive in life. So, and that was the whole impetus, because it's not going to make a world of difference for me dollar wise, but if I can alter and improve somebody's life by here, take this book, and then they get donation, so to speak, then hey, it's a win-win-win-win-win, right? Again, that's the whole process.
I appreciate it. So I have one last question for you before we go.
Yeah, because we got 2 minutes left.
Right now, it's an interesting time in the market. And one of the things I struggle with giving clients advice is there's no right or wrong answers in a lot of situations. So is there, for someone who's trying to figure out, should they buy an investment property? Should they sell investment properties? Just someone who's stuck. Is there any advice you'd give them or something you'd suggest they consider?
Well, yes, I'd suggest that they speak to you first to see what they're financially capable of. That's number one. Or number two. Number one, what are they trying to do? Figure out your why. Why are you investing in real estate? What is your end goal? It's like planning a trip. You want to get to, destination down the road. How are you getting there? Where are you starting from? What tools do you have that you can use now? What tools do you need? Speak to people that have already gone down that road. Get advice from them. Try and learn from their mistakes. Learn from their wins. Be a learner. At 63, I'm still learning. I'm still reading. I'm still going to educational events.
No, I get you, and I appreciate it. I think it's true, though. One of the biggest mistakes I see investors make, and people in general, is they learn something, they find success at it, and then they just do it blindly until one day they realize that they've dug themselves a hole doing something that was working for them before. And I think that we all have to throw our egos aside, and we have to accept that we're going to make good decisions and bad decisions, and we have to be honest with ourselves when we judge that, and looking for changes and pivoting. I know it's a cliche word and it's overused a lot, but we have to adjust what we do as things change. I'm still watching some flippers aggressively riding private money flips, along with the market as it changes. And I see my really capable investors slowly toning back and adjusting their thresholds. And I see some of the newer investors and they're just still full throttle. And I'm like, guys, you should go take some of the really good flippers out for dinner and see what they're doing right now. So, but I appreciate it, Andrew. It's always a pleasure.
You're welcome.